This is the Chapter 2 in-class problem. We need to write the journal entries for these external transactions and then post to the T accounts and then prepare a trial balance. So I made a little bit of space in here between the transactions, and I'm going to try and write the journal entries in the space that I've created. Brooks invested $150,000 cash along with $22,000 in office equipment in exchange for common stock. So I'm going to change that sentence around a little bit so I can say we from the perspective of the company. We received $150,000 cash from an investor, along with $22,000 in equipment from an investor in exchange for common stock. So when we're looking for the duality, when we're looking for the accounts, there's actually three accounts here that we've got. We've got cash in, we've got equipment in, and we've got common stock issued. So those are our three accounts. Cash, like I said, cash in, so it increased. Equipment in, that increases as well. And common stock issued, that's also an increase. Cash is an asset account, so we increase asset accounts with a debit. And office equipment is an asset account. We increase asset accounts with a debit. And common stock is an equity account. We increase equity accounts with a credit. So now we know debits and credits. We need to know the amounts. The cash amount is going to be $150,000. The office equipment, $22,000. And then the common stock is just going to be the sum of those two numbers, $172 it looks like. Let me write that up. We're going to debit. We put our debits first. We're going to debit cash for $150,000. We're going to debit office equipment for $22,000. We're going to credit common stock. We're going to credit common stock for the sum of those two. 172. Man. I'm left-handed, and sometimes that ends up with me pressing weird buttons. Okay, the next one. The company prepaid $6,000 cash for 6 months rent for an office. So we're looking for our two accounts, cash and rent. So this one is a little different. Because we prepaid this expense, we're not recording it as an expense. We're going to record it as a prepaid expense. And when we do that, we will substitute the word expense for whatever type of expense that is. So here, this is rent expense. When we're paying rent expense early, we're going to call it prepaid rent. Prepaid rent is not an expense. Prepaid rent is an asset. So I'm going to write this here. This is prepaid rent, and actually they have it right there. This is prepaid rent. Prepaid rent is an asset that we are increasing. We increase assets with debits. And the other account is cash. We're increasing cash. And we do that with a oh, I'm sorry, we're not increasing cash. We prepaid $6,000 cash for rent. So we spent cash. We are decreasing cash. Cash is an asset account. We are decreasing it. We decrease asset accounts with credits. And the amount is $6,000. So I'm going to debit prepaid rent. I don't know if I should continue to try and force all this stuff in here. I'm going to try. Prepaid rent is our debit for $6,000, and cash is our credit for $6,000. Next, we made credit purchases of office equipment for $3,000 and office supplies for $1,200. Payment is due within 10 days. So this is accounts payable. Making a credit purchase means we didn't pay cash right now. So this is accounts payable. Accounts payable is a liability account. We are increasing it. We owe more money now because of this. We're increasing it. We increase liabilities with credits. And then we've got office equipment, which is an asset. We brought more office equipment into the company, $3,000 more, and office supplies, which is an asset. We brought more office supplies into the company. So we increased both of those. We increase assets with debits. So here's what our journal entry looks like. Office equipment. Use some, there we go. Some abbreviations. $3,000 debit. Also, office supplies. $1,200 debit. And the credit account is accounts payable. And that amount is the sum. What's that? $4,200. So there's our journal entry. Next, we completed services for a client and immediately received $4,000 cash. So we need to find our accounts. Cash. I've said I always love when I see that in a sentence because I know that's going to be one of my accounts. We completed services. So that is revenue. And I don't know if this company has different types of revenue. I'm just going to call this services revenue just in case. When we receive cash, we debit it to show the increase in cash. So our journal entry is going to be a $4,000 debit to cash. And when we have revenue, that's automatically a credit. So I'm going to credit, I'll call it service revenue for $4,000. There's my journal entry. That's one that you see a lot. This top one, we see that top one a lot where we bring in cash for common stock or we bring in some other asset for common stock. So number one, you should see, you should know that one because you're going to see it a lot. You should know all of these. But the one we just did here, number 6 also, that's a big one. make sure that you are completely comfortable with recording earned revenue. Next, we completed a $7,500 project on credit for a client who must pay within 30 days. So we have done a job and completed it, so we've earned it. So this is going to be revenue also. And it doesn't quite say that in there, but this is service revenue. And the other account is accounts receivable, sorry. Accounts receivable, because a customer has paid for something on credit with us. So it means the customer owes us accounts receivable. Accounts receivable is an asset account that we're increasing. We do that with a debit. And service revenue is always a credit. So the journal entry. Oh, not sure what I'm touching here. There we go. So the journal entry, I'll squeeze it out over here. Accounts receivable, $7,500, and service revenue, $7,500. Next, we've got 12 that says the company paid $4,200 cash to settle the accounts payable created back on March 3rd. So up here on March 3rd, we bought office equipment and office supplies for $4,200 and charged it to accounts payable. So now on the 12th, we're paying off that $4,200. So our accounts are going to be cash and accounts payable. We paid cash, so cash is going down, and we've paid off what we owe in this accounts payable, so that is also going down. Cash is an asset account. We decrease asset accounts with a credit. And accounts payable is a liability account. We decrease liability accounts with a debit. So our journal entry is going to be, let's see, I'll write it over here. Our journal entry is going to be a debit to accounts payable for $4,200 and a credit to cash for $4,200. Next, we've got 19, which says we paid $5,000 cash for the premium on a 12-month insurance policy. So normally when we pay insurance, we would call it insurance expense. That's when we're paying it and using it almost immediately after. But this is a prepayment that goes 12 months out. So we're going to record this as an asset called prepaid insurance. And the other account is cash. We paid cash, so cash is decreasing. And we bought this prepaid insurance policy. So prepaid insurance is increasing. Prepaid insurance is an asset. We increase assets with a debit. And cash, when we decrease cash, we do that with a credit. So our journal entry, prepaid insurance, is debited for $5,000 and cash is credited for $5,000. Next is 22. It says we received $3,500 cash as a partial payment for the work completed back on March 9th. And so March 9th, there's March 9th right there at the top. March 9th, we recorded accounts receivable for the $7,500 worth of work. And now we've received part of that to pay down accounts receivable. So our accounts, we received cash. And it doesn't say it here, but the other account is accounts receivable from back on March 9th. Accounts receivable is going to go down because this customer owes us less money now. Accounts receivable is an asset account. To decrease an asset account, we credit it. And cash, we received cash. Cash is going up. To increase cash, we debit it. So our journal entry is going to be a debit to cash for the $3,500 and a credit to accounts receivable for $3,500. They haven't completely paid what they owe us. They still owe us what? $7,500 minus $3,500. They still owe us $4,000. But we have reduced the balance in the accounts receivable account from $7,500 down to $4,000 with this $3,500 credit. Next, 25, we completed work for another client, $3,820 on credit. This is one of those that are, a little tougher because it doesn't say the account name. We completed work, so we're going to call that service revenue. That's one account. And the other account, it says they didn't pay us cash, they paid us with credit. On credit, on account, with accounts receivable, or all different things that you might see. That means accounts receivable. So service revenue is always going to be a credit. Accounts receivable is an asset account that we're increasing. We do that with a debit. So this journal entry will be a debit to accounts receivable for $3,820 and a credit to service revenue for $3,820. 29, the company paid a $5,100 cash dividend. So our accounts are cash and dividend. We paid $5,100. We paid $5,100, so cash has gone down. And we paid a dividend, so dividend goes up. Dividend is kind of like expense. A dividend is not an expense. It's separate. It's a different type of account, but it acts similarly to an expense. Specifically, it's got a negative relationship with equity. So we increase equity with a credit, But because dividend has a negative relationship with equity, we're going to increase dividend with a debit. And we're decreasing cash, we do that with a credit. So our journal entry is a debit to dividend for $5,100 and a credit to cash for $5,100. 30, we purchased $600 of additional office supplies on credit. So our accounts, office supplies, and on credit, when we purchase on credit, it means accounts payable. So there are two accounts. We purchased office supplies. So that means office supplies has increased. Office supplies is an asset account. We increase asset accounts with a debit. Accounts payable is a liability account. We owe more money now because we've bought on credit. So we are increasing that liability account. We increase liability accounts with a credit. So here's our journal entry. Office supplies, I've got a lot of white space out here, I'll use it. Office supplies, is going to be our debit for $600, and our credit will be accounts payable for $600. And then the last one, 31, says we paid $500 cash for this month's utility bill. So our accounts are going to be cash and utility expense. Utility expense is an expense account. We are always going to debit expense accounts. And cash, we paid cash, so that means our cash went down. When cash goes down, that's a credit. So our journal entry is a debit to utility expense for $500 and a credit to cash for $500. There's all of our journal entries. Take all of the opportunity that you can to look through problems like this and write out journal entries, because that really is an extremely important part of this class this semester. And you should be able to go back and forth. Of course, you should be able to go from the sentence to the journal entry. But if you see a journal entry, you should be able to turn that back into an English sentence. You should be able to read the journal entry and understand what happened, what the external transaction was. Okay, so that is requirement 1. Write all the journal entries. And requirement 2 is post them to the T accounts. So this is what I'm going to do. I'm going to, take a highlighter here. And I'm going to post every line from all of these journal entries, one by one. I'm going to post them over to the T accounts. So this is a debit to cash for $150,000. So I find my cash account and I put in the $150,000 debit. It's helpful to put the date there as well, so you can tie the number to the entry. But I'm just going to zoom through these things. I'm just going to put the debits and the credits down. Next, I've got a debit to office equipment for $22,000. So office equipment down here, $22,000. And then I've got a credit to common stock for $172,000. A credit to common stock for $172,000. I've got a debit to prepaid rent for $6,000. A debit to prepaid rent for $6,000. I've got a credit to cash for $6,000. Next, I've got a debit to office equipment for $3,000. I've got a debit to office supplies for $1,200. And my credit is accounts payable for $4,200. And then I've got a debit to cash for $4,000. And I've got a credit to service revenue for $4,000. I've got a debit to accounts receivable for $7,500. And a credit to service revenue for $7,500. I've got a debit to accounts payable for $4,200. And a credit to cash for $4,200. I've got a debit to prepaid insurance for $5,000. And a credit to cash for $5,000. Oops. I've got a debit to cash for $3,500. And I've got a credit to accounts receivable for $3,500. I've got a this is why I'm highlighting all those pieces, because it's easy for me to get lost. And if they're highlighted, it's a little harder for me to get lost. A debit to accounts receivable for $3,820. And a credit to service revenue for $38.20. I've got a debit to dividend for $5,100. And a credit to cash for $5,100. And I've got a debit to office supplies for $600. A credit to accounts payable for $600. My last two, a debit to utility expense for $500, and a credit to cash for $500. So I'm going to go back over this thing and look quickly to make sure I have marked off all of my journal entries. I don't want to miss one. If I miss one, then my account balances and my trial balance will be off. It looks like I got all of the pieces from all of those journal entries posted to all of these T accounts. The problem tells us to track the balance. When you do this problem in Connect, I think the computer automatically tracks it. But for cash, which is an asset account that has a normal debit balance, here's what the balance would look like. I'm just going to run through cash really quickly. Let's see. We start off with $150,000, so that's our balance, and then we reduce it by $6,000, so it goes down to $144,000. And then we increase it by $4,000, so it goes up to $148,000. And then we decrease it by $4,200, so it goes down to, I've got the numbers here in front of me, so it goes down to $143,800. And then we decrease it by $5,000, so it goes down even more to $138,800. Oops. And then we increase it by $3,500, so it goes up to $142,300. And then we decrease it by $5,100, so it goes down to $137,200. And then we decrease it one more time by $500, so it goes down to $136,700. So that's what the balance column is going to look like in all of these. Start off with $7,500, drop it down to $4,000, and then raise it up to $7,820. Start off with $1,200 and then raise it up to $1,800. So I'm not going to do this for all of them, but just so you know what it should look like. Oop, 25. And then all of these are on the asset side, so they all have the normal debit balances. When you get over here, you've got to think about what is the normal balance. So accounts payable is a liability account. It's got a normal credit balance. So that'll be $4,200, and then it drops down by $4,200, so it goes down to 0, and then it goes back up to $600. Okay, I'm going to stop right there. The answers are in the text. Oh, you know what? I can't stop right there. I've got to continue doing this because I need the ending balances in order to put together my trial balance. So like I said, I think in Connect, it does this for you. It does these balance calculations for you. But here, since I'm doing mine on paper, I do need to continue doing this. So common stock has a normal credit balance. So that means 172, And dividends have a normal debit balance, so we're going to put 5,100 there. Service revenue has a credit balance, so it's 4,000, and it goes up to 11,500, and then it goes up to 15,320. And then the utility expense has a normal debit balance, so we're going to show it as 500. Okay, I didn't think I was going to do them all, but I did have to because I need the final balance for all of these accounts. Because I'm going to put all these together to create my trial balance. And now, notice these. I've said in class that we don't really have to worry about these account numbers. But in this problem, they do have account numbers, and they're listed here in order of their account numbers. We'll kind of see this order throughout the semester. Cash, accounts receivable, office supplies, prepaid insurance, prepaid rent, office equipment. It'll kind of stay in this order, and then we go to liabilities, accounts payable, then we go to equity, common stock, dividends, service revenue, and expenses are at the very end. We'll kind of see this order throughout the semester. We want to put these accounts in this same order on the trial balance. It will help us when we make the financial statements. We're not going to do that here. We're just going to stop at the trial balance, but keeping them in this order will help. So cash, oops. Cash, I'm just going to write down all my accounts first. Accounts receivable, office supplies, prepaid insurance, prepaid rent, office equipment, accounts payable, common stock, dividends, service revenue, and utility expense. So those are all of the accounts that I had journal entry pieces for. Our chart of accounts will have many more accounts in it, but these are just the ones that we used. And now I'm going to move over those balances. I want to make sure that I'm careful about debit balance and credit balance. So everything here on the asset side is going to have a debit balance. 136,700, 7820, 1,800, 5,000. Got to make sure that I don't mess up with my bad handwriting. 6,000. And 25,000. Next, we're going to do accounts payable. Remember, accounts payable has a credit balance. So that is 600. And common stock also has a credit balance, 172,000. Dividends has a debit balance, 5,100. Service revenue has a credit balance, 15,320. And utility expense has a debit balance, 500. Now we total these things up. All of the debits get totaled and all of the credits get totaled. and they need to equal each other. So like I said, I've got the answers here in front of me. Total all those debits, that should be 187,920. And total all of those credits, and that should be 187,920. If they don't equal, it means there's a mistake somewhere. That is in-class problem chapter 2.